Welcome to the long game, building wealth without the complexity. In this video, we will explore a simple, resilient approach to investing that works over decades. We will focus on account prioritization, why simplicity typically beats complexity, how to handle cash and liquidity trade-offs, and how to implement a globally diversified portfolio using low-cost index funds. We will also include quizzes to check your understanding. Let's get started. Here is our agenda. First, we'll discuss why simplicity wins. Next, we'll prioritize accounts including 401k, Roth IRA, and Brokerage. Then, we'll address cash strategy by comparing high-yield savings accounts and short-term government bond ETFs. After that, we'll construct a core portfolio with a 70% U.S. and 30% international mix. We'll also examine factor tilts and when to consider them. Then we'll cover implementation steps and automation. Finally, we will talk about risk, behavior, and the importance of staying the course. Before we dive in, a quick disclaimer. This video is for educational purposes only and is not financial advice. Please consult a qualified professional for personalized guidance based on your circumstances. Investing involves risk, including the potential loss of principal. With that said, let's move forward thoughtfully. Why does simplicity win? Over long horizons, a low-cost, globally diversified portfolio tends to outperform more complex strategies due to lower fees, fewer behavioral errors, and consistency. Simplifying decisions also makes it easier to stick with your plan through market cycles, which is essential for compounding to work. Now let's establish the account foundation. Start by capturing your full employer match in the 401k. This is effectively a guaranteed return. Next, if eligible, prioritize maxing a Roth IRA to take advantage of tax-free growth. After that, use a taxable brokerage account for additional investing. Maintain a checking buffer and a true high-yield savings account for emergencies to ensure immediate access to funds. Finally, consider short-term government bond ETFs for cash you do not need instantly but may need within months, being mindful of access and settlement timing. With accounts set, let's handle the cash controversy head-on. Let's compare HYSAs with short-term government bond ETFs. High-yield savings accounts typically allow near-instant access, can be FDIC or NCUA insured, and are ideal for emergency funds. Conversely, a short-term government bond ETF may offer a somewhat higher yield but requires placing a sell order during market hours. After selling, settlement and transfer to your bank may take 1 to several business days, depending on your broker and bank. As a result, ETFs may be better for cash that you do not need the same day, while HYSA is better for a true emergency fund. Next, let's visualize what happens during a sudden expense. This flowchart illustrates emergency liquidity. An unexpected expense triggers the need for funds. If you need money immediately, you draw from a checking buffer and then an HYSA, which can transfer quickly. If you have time, you may sell a bond ETF, but those proceeds settle before they can be transferred, introducing a delay. This structure highlights why HYSAs are best for emergencies and bond ETFs are better for near-term but non-urgent cash. With a 40-year horizon, compounding does the heavy lifting. Time in the market is far more important than timing the market. Diversify globally to reduce single-country risk. Keep costs low, as even small expense ratios compound significantly over decades. Automate contributions to enforce consistency and reduce reliance on willpower. Now, let's define a core portfolio that fits this approach. A powerful, simple portfolio uses core, market cap weighted index funds. A baseline is 70% U.S. total market or S&P 500 exposure, and 30% international via VXUS for global diversification. And a taxable account, 75% VOO and 25% VXUS, is also highly efficient and simple. This broad exposure reduces individual company and sector risk while keeping costs minimal. Fewer decisions make it easier to stay invested through volatility. Before adding any complexity, let's examine the factor investing trap. Factor investing can be attractive, including small value, momentum, or quality tilts. However, these approaches can underperform the market for long periods, creating tracking error that tests investor psychology. Additionally, using multiple factor funds usually increases expenses and potential tax costs. The practical advice is to first build a robust, fully funded core portfolio. Only then consider factor tilts if you understand the risks and are prepared to stick with them during inevitable underperformance. Next, let's walk through a simple implementation plan. Implementation is straightforward. First, open or confirm access to your 401k, Roth IRA, and taxable brokerage accounts. Second, set automatic contributions aligned with your pay schedule. Third, select core funds, such as VOO for U.S. exposure and VXUS for international exposure. Fourth, allocate to either 70/30ths in general or 75/25ths for taxable simplicity. Fifth, rebalance annually or when allocations drift by about plus or minus 5%. Keep fees low and stay consistent. Now let's test your understanding with a quick quiz. Quiz time. Which is generally better for immediate emergency access? A high-yield savings account or a short-term government bond ETF? Option A, HYSA. Option B, short-term government bond ETF. Option C, they are equally liquid. Option D, neither is suitable for any cash. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is the HYSA. A high-yield savings account generally provides near-instant or same-day access to funds, making it more appropriate for emergencies. Short-term government bond ETFs may offer a slightly higher yield, but they require a sale during market hours, and proceeds generally settle before you can transfer them, which introduces delay. Now, let's reinforce tax efficiency and account order. Key tax and efficiency priorities include capturing the full employer match in your 401k, then maxing a Roth IRA if you are eligible, and considering a backdoor strategy if appropriate. Use a taxable brokerage for additional investing, preferably with core index funds. Minimize turnover and avoid unnecessary complexity to reduce taxes. Keep expense ratios and transaction costs low. Next, a quick reference table will help you remember the hierarchy. This table provides a quick reference for account priority. First, contribute to the 401k up to the employer match. Second, fund the Roth IRA for tax-free growth. Third, consider contributing more to the 401k for tax-deferred growth. Then, invest additional savings in a taxable brokerage account. Maintain a high-yield savings account for emergency liquidity at all times. Now let's cover the simple brokerage strategy you can implement right away. In your taxable brokerage account, keep it simple by using the same core index funds, such as a 75% VOO and 25% VXUS allocation. Avoid adding factor tilts in taxable accounts when you are starting out, as they increase complexity and potential tax drag. Set dividends to automatically reinvest, and automate monthly contributions. Finally, stay focused on the long term, and avoid reacting to short-term market noise. To keep you on track, here is a simple annual rhythm. This Gantt chart shows a practical annual investing rhythm. Monthly auto-investing runs throughout the year. A mid-year rebalance check is scheduled around the halfway point, using a plus or minus 5% threshold. A tax review is planned for the fourth quarter, and emergency fund refills occur as needed during the year. These scheduled touchpoints help you maintain discipline without constant tinkering. Next, let's talk about the behavioral edge you gain by keeping things simple. Behavioral discipline is your true advantage. A simple structure reduces decision fatigue and the risk of making reactive mistakes. With fewer moving parts, you are less likely to abandon your plan at the worst possible time. Write a concise investment policy statement that covers your allocation, contributions, and rebalancing, and commit to following it. Volatility is normal. Your edge is staying invested. Let's check your understanding with one more quiz. Second quiz. When is it reasonable to consider adding factor tilts such as small value or momentum? Option A, right away for maximum return. Option B, only after building and fully funding a robust core portfolio and being willing to accept long periods of underperformance. Option C, never, because factors do not work. Option D, only in taxable accounts for better taxes. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is the option that recommends adding factor tilts only after you have built and fully funded a robust core portfolio, and after accepting that factors can underperform for long periods. This approach acknowledges both the potential benefits and the behavioral challenges. Now, let's summarize the key takeaways and close out. To summarize, prioritize the 401k match, then the Roth IRA, then additional 401k contributions, and finally, taxable investing. Use a high-yield savings account for emergencies, and reserve bond ETFs for cash you do not need immediately. Build a simple core portfolio of approximately 70% US and 30% international, or 75% and 25% in taxable accounts. Avoid early complexity and factor chasing. Keep costs low, automate contributions, rebalance periodically, and stay invested for decades. Thanks for watching. If you found this helpful, please like the video, share it with a friend, and subscribe for more straightforward investing content. In the comments, share your plan and how you are simplifying your portfolio. See you in the next one.